Hello, all. I trust we all had a very good week last week, and that's because last Wednesday, the Fed decided that they were going to do a pivot. And now, most news days aren't the sort of things where I feel like I need to go out and make any kind of portfolio changes. However, last Wednesday was one of those days where I did feel like I have to go out and make some kind of changes. And that's because right now I hold a lot of treasuries in cash and very few individual stocks. But now I feel like the riskier play is to hold on to bonds and, well, these short duration treasuries that I have and cash, because I feel like those traditionally safer assets are going to be way outperformed by the S&P 500 index, we'll say, for like the next year. So what happened, and like, why is the Fed pivoting? Well, I believe that a lot of the reason why they're pivoting right now is political, but that's just my opinion. I think it's politically motivated, but who cares anyway? It doesn't really matter. All that matters is that they did. And so Jerome Powell, he gave us basically an early Christmas present that's expected to last through 2024. And what happened was it just sent a whole bunch of money into the market, either in the form of bonds or in the form of stocks. You saw the bond yields crash down and the stock market go up. And it's pretty rare when everything floods into stocks and bonds. But that's what happened last week, because this pivot was well, it was unexpected is what it was, because really inflation hadn't changed much since last June. If you look at the inflation rate in June, it was 3. If you look at it now, it's 3.1. So it caught a lot of us flat-footed. Personally, I was running a play on a 60-40 portfolio where 60% is in U.S. Treasuries, as laddering short duration Treasuries, and then the 40% was a combination of cash that I was using to run options with and Nvidia shares, and a small position in coupon. But just by and large, it was Nvidia because the coupon was only 2%. Now, when I look at my portfolio after the Fed pivot, now I start seeing a lot of risk, because I think there's a lot of risk in that treasury position and there's a lot of risk in that cash position. And so I thought it was a good idea, and I haven't done yet liquidated the treasuries because they haven't matured, but I thought it was a good idea to liquidate my cash position and buy an individual stock. I'll show you which one I bought a little bit later on in this video. And as my stocks mature, I'm going to take my 60, or as my treasuries mature, I'm going to take my 60% treasury position and start putting that into ETFs. And prior to researching this video, I didn't really know which ETFs I was going to go into, but after getting all of my ideas and my thoughts together on the screen here, I think I have a good idea of which ETFs I'll be going into, and they're not going to be utilities and staples. I do believe that those look a lot more attractive. Those sectors have been hit pretty hard in the past year, and now their dividends are going to look just more attractive relative to, say, what the yield is on a 2-year treasury or something like that. Their yield on these dividends is going to look more attractive than it did, say, a week ago. But nevertheless, I'm not that conservative, so I'm going to take a little bit more of a risky play when I'm going with my ETFs. So in this video, we'll have a look at the sort of things that I'm looking to buy. And like I said, I haven't bought them yet because the bonds haven't matured. But let's go ahead and have a look at my portfolio and I'll show you what I mean. All right, so here are the options and fixed income portion of my portfolio. You can see that I have 3 options open. Sold 2 calls against Nvidia, and I sold 1 call against Goldman Sachs. Surprise, surprise. That's the equity that I ended up buying with my cash position, Goldman Sachs. I'll get into the reasons why I bought that a little bit later on in this video. You could say I let the cat out of the bag. All right, kitty, sing the song of your people. All right, so and then on my fixed income portfolio here, you can see that I'm going to have about 75,000 treasuries mature on Monday. With this money, I'm going to go ahead and buy a couple of ETFs. I also have some more treasuries maturing at the beginning of January, and this one is also beginning of January. So I'm going to be taking the money out of these bonds and I'm going to be buying ETFs. And so which ETFs am I going to buy, and why did I choose Goldman Sachs? Well, let's go ahead and have a look at that. Now, the first thing that I wanted to do was get out of my cash position and go find a single stock to buy. So I would say, well, what about one of the next seven stocks? You know, we all know about the Mag 7. I already own NVIDIA, which is the bluest of the blue chips. I do love other Mag 7 stocks. I love Amazon. I love Microsoft. But what about something outside of that top seven? So what I did was I pulled up the Vanguard S&P 500 ETF. This is like the standard bearer ETF. Like if you're going to own one thing, and let's say you're a completely passive investor and you're just going to put money into something every 2 weeks, this is the one that you do it with. And if past is prologue, after, I don't know, 20, 30 years, you'll have done pretty well with your money. But down here, they'll go ahead and show their holdings. And then in here, you're going to see the Mag 7. You can see Microsoft, Apple, Amazon, NVIDIA, Google, Meta, and Tesla. But what's the next seven? So the next one after that would be Berkshire, and this is more of an ETF than it is a single stock holding, although they do hold a lot of Apple, American Express, Chevron, and Bank of America. That pretty much rounds out the top like 75% of this ETF. You got United Health, which I'm not crazy about health stocks, only because I think it's weird to profit off someone else's illness. I don't favor those. And then after that, you've got Eli Lilly, JP Morgan, Exxon, Visa, and Broadcom. And, and while I'm on this, here's Eli Lilly, all right? Okay, so when you look at Eli Lilly, you're going to see a stock that has a price to earnings ratio that is 103, right? Now, if this was Microsoft and it had a 103 price to earnings ratio, that's all you would hear about every day on CNBC. But some stocks, the price to earnings ratio doesn't matter. The stocks that are really held accountable are going to be your tech stocks. Now you can see it's got a forward PE of 86, and so it's a good growth company. But you know these guys, they don't have they're not held accountable the way say Microsoft and Apple and NVIDIA and any tech stock really is. Here's Costco. It's got a price to earnings ratio of 44 with a forward PE of 42. You never hear anybody complain about how expensive Costco is, but that's okay because it's got a 2% profit margin. It's got no profit margin. It's got a really high PE, but you never hear a word about how expensive Costco is. Another one might be, say, something like, I don't know, Clorox. Here's a consumer staple company. It's trading with a price to earnings ratio of 213. But believe me, if this was Microsoft, you would know if Microsoft was trading at 213. You don't know this about Clorox. It does have a forward PE of 30, which I think is about a little bit more expensive than Microsoft, but not a lot more expensive. Certainly more expensive than NVIDIA. NVIDIA's forward PE is about 23. And so, we're talking about a company in NVIDIA that is a very good deal relative to stuff like Eli Lilly or Costco or Clorox or probably Chipotle here. Chipotle is going to be trading at a price to earnings ratio of say 53 with a forward PE of 51. It's got no growth at all, but I don't mind that. It sounds like I'm complaining because maybe I am, but I don't mind that the likes of Apple and Meta and Amazon and everybody have their feet held to the fire like that, because if they weren't and they were like allowed to spiral out of control like some of these other stocks that are supposedly not overpriced but only tech stocks are, how much would Microsoft cost right now? The barrier to entry would be like $1,000 a share. Apple would be like $1,200 a share. NVIDIA would be like $2,000 a share or more. So at least it allows us to get into the best companies in the world at a reasonable price. And then the other thing it lets us do is, as soon as they say get up to like say 38 price to earnings ratio, it's all over the media. It's like, oh my gosh, look at how expensive it is. So it lets us know that we can trim our position if we want to take a little bit of money, take a little bit of profit in Microsoft. When it gets up to 38, trim a little because it'll come back to 31 because that's all they're going to talk about is how expensive it is. But you'll never hear about it on some of these other companies. But I digress. So why did I get into Goldman Sachs? Well, the reason is this. For starters, I think that the stock market is going to be a lot busier, like a lot more enthusiasm in the coming year as rates start coming down. And I think one of the benefactors of that is going to be Goldman Sachs. And one of the things they do is they bring companies public. And so I think there's going to be a lot more like IPO fever this year than there was last year. The other thing is, I think that they're kind of a turnaround story because a lot of their bad news is kind of in the rear view mirror. Like what they tried to do was they tried to start a consumer bank such as JP Morgan or Bank of America. And what happened is it was a failure. And they started in 2018, but basically they divested from that venture in this past year, causing the company to have a very bad year. And for this reason, you can see that Goldman Sachs year over year earnings where like net income was down 33% and net profit down 34%, earnings per share down 38%. I expect all of this to turn around. And when you're going to see their incoming profits, you're going to see year over year, it's going to be up like 110%. You know, it's going to look astronomical. And so it's going to be because of the cyclical nature of IPOs. And I think we're going into a good cycle, and the fact that a lot of their bad days are behind them, and we're going to do year on year comparisons of some bad days with renewed stock market enthusiasm. I think Goldman Sachs stands to have a very good year this year, and that's why I went into Goldman Sachs. Now, before we get into the ETF portion of this here video, let me first go over what all these rate cuts mean for, say, borrowing and for the market, and what the market's actually pricing in before I talk about which ETFs I'm going to decide to buy. So if we look here, the rate cut probability here in January is 18%. It's 90% in March, 100% in May, and 100% in June. And this is what the market is pricing in. This is the expectation for cuts in the foreseeable future. The Fed says that at the end of 2023, that it's going to be 5.4%. And this is off of their summary of economic projections. They're saying that's going to be 4.6% at the end of 2024, 3.6 at 25, and 2.9 in 2026. Now, this is a guess, but if it should all go according to plan, we're going to have a few really good years in the stock market. Now, this 5.4 to 4.6% would indicate that the Fed is planning on 3 rate cuts next year, because that's a difference of 0.8, and each rate cut is 0.25. You multiply that by 3, you got 0.75. So the Fed is projecting 3 rate cuts. However, what the market is pricing in right now, and this is a typo right here, the future markets of this, like the market is like bold now. They're saying, no, you're not going to cut 3 times next year. You're going to cut 7 times next year. So they're expecting it to come down 1.5% next year. And the market, why I'm saying they're being bold is because finally the Fed came to the market, because the market's been pricing in 3 rate cuts next year for a very long time. And finally the Fed met the market. Now the market's taking it a step further, saying, no, we think you're going to do 7, and what they're expecting is the Fed to meet the market again. So the reason for a lot of this optimism is because now the market is pricing in 7 rate cuts for 2024. So what does that mean, say, for things like housing and borrowing and things of that nature? Well, they're expecting that it's going to be aggressive, and I'm guessing it has something to do with the election. You know, I am not sure. But right now, the interest rate is 5.5%. If you get 7 next year, that's what, 1.75%, takes us down to 3.75% at the end of 2024. And that's what the market's pricing in. If we get let's call it 4%. If we have an interest rate that's 4%, well, what does that do for, say, the 30-year mortgage? Well, the 30-year fixed mortgage traditionally goes around 1.5 to 2 percentage points beyond the 10-year fixed income rate or the 10-year yield. And if it's at 4, you'd expect that at the end of year, you would expect interest rates on borrowing for, say, a 30-year mortgage would be 5.5% to 6%, right? When we look at the 30-year versus the 10, right now the 30-year fixed mortgage is sitting at 6.6, and the yield is at 3.97. So right now they're about 2.6% off. And the reason it's a little bit high is that the Fed keeps selling mortgage-backed securities back to the market. So this 30-year mortgage rate to the 10-year yield, it's a good comparison, but there's a little bit more to it than that. There is a mortgage-backed security component of this equation. All right, so now we're thinking that the 30-year fixed at the end of next year is going to be somewhere south of 6, but north of 5. Let's call it 5.5. Is that enough to stimulate the housing market? We don't really know. but we think that it could, and that the following year it's going to be even lower. So is next year's housing market going to trade on 2024, or is next year's housing market going to trade on 2025? If again, if past is prologue, the way the market works, it's not going to trade housing in 2024 based on 2024 rates. It's going to base it on 2025 rates. So it's going to be basing it on mortgage rates being somewhere south of 5, but maybe north of 3.5 or north of 4, we'll say. And that will be enough to get this market going. So let's go back to that PowerPoint presentation and we'll talk about what ETFs I was actually considering to occupy my 60% treasury position. So I was looking, okay, we'll use this as the benchmark, the S&P 500. We'll use VU as the benchmark and we'll compare other ETFs to this benchmark. So other things I was interested in, maybe Berkshire might be an interesting ETF to use. I'm not crazy about their huge position in Occidental Petroleum, but let's just see how Buffett compares to the S&P 500, say, over the last 5 years. I was also considering a little bit more aggressive play with the NASDAQ 100. The equal weight S&P seems to be like all the rage right now. Everybody's like, oh, don't get into like, let's just go equal weight. It's going to be pretty much a peanut butter spread of gains next year, not so much in just a few of the top market weight stocks. So the equal weight S&P 500 ETF seems to be pretty popular right now. There's the MAGS, which is the Magnificent Seven ETF that Roundhill puts out. Maybe just sticking to that. That looks like a pretty good play if you're, if I'm honest. Or maybe I think a particular sector is going to do well, like the industrials. So XLI might be a consideration because I think that Home Depot, Lowe's, Deere, Caterpillar might have a really good year next year as we're looking forward to 2025. I've noticed that a lot of these cybersecurity stocks, it just doesn't matter what happens in the news. It's like almost like no price is too high to pay for Palo Alto and Zscaler and Datadog and all that stuff. So maybe the cybersecurity ETF might be one to consider, or perhaps the semiconductor ETF SMH. Like to me, semiconductors now is like the new oil. Like everybody needs it. Like we're going to start a war apparently over in Taiwan over semiconductors. We're trying to onshore semiconductors. It's like semiconductors is kind of like makes this world go. You're watching this on something that's likely running about 40 semiconductors. You call somebody on the phone, 9 semiconductors. You drive your car, hundreds of semiconductors, like everything semiconductors. So I'm really interested in the semiconductor ETF as I think it kind of makes the world tick. Now you've also got the home builder ETF, the ITB. And as I think we're going to have a pretty strong housing market in 2025, 2024 might not be a terrible year to get into the home builder ETF. Now, some that I was considering, but they're like honorable mention ones, but I'm not actually going to do, would be like the Russell 2000. Honestly, I just if you look at the stocks in the Russell, I'm just not that hyped to invest in them. There's a reason why they underperform, and I'm just not going to get into those right now. You might get a little sugar high out of it. You might get, like some unprofitable tech stocks or unprofitable stocks in general might shoot up for a little bit, but it's temporary, and I just don't feel like I'm going to put my money in the Russell. Other things that if I really want to throw the dice, commercial real estate has been taking a beating, right? As have regional banks. So if I really want to get aggressive, maybe I go into a commercial real estate ETF, or maybe I go into a regional bank ETF, or maybe the transports catch fire again next year. Transports, now things that are in the transport ETF would be like United Airlines, American Airlines, but of course you're going to have UPS, FedEx, Union Pacific. What I don't like about this transport ETF is I'm not sure that there is anything in this ETF that is not unionized. And every time one of these companies gets their head above water a little bit, the labor union comes in and knocks them down. And I think that's great for the workers. Get your money, that's great. But I'm just saying, as an investor going into these companies, I don't like that there's a ceiling on how much money that they can make. So I'm going to avoid that one. And last but not least, there's TLT. We do expect that if the rates go down, that that bond prices at today's price will go up. So because bond yields work inversely to bond prices. So right now, if you buy it, if they keep cutting rates, what you buy today is going to be worth way more in a year or two. But this has already run a little bit. I expect it to run more. It could run a lot more, but this would be one to consider, but I'm just not going to play that game. I'm not going to buy this one, though I wouldn't fault anyone for buying this particular ETF. So let's go ahead and compare the performance over time of some of the ETFs that I am considering using the S&P 500 as the benchmark. So right now we have the S&P 500, and I think that it's fair to go ahead and I'd say use, say, a 5-year comparison. And some on this list would be, say, Berkshire Hathaway, right? BRKB. And if we look at it over the course of, say, 5 years, you can see that actually, if you look here, Berkshire is up 85%, while the S&P is up 95%. So the VU is actually outperforming Warren Buffett over the last 5 years. Now, another one on that list is the NASDAQ 100. Let's see how the NASDAQ 100 has compared to the S&P 500 over the past 5 years. You can see the NASDAQ is up 175%. Okay, so now this would be the direction that I'm kind of thinking. Like, I think the NASDAQ, it does move with the market. When the market goes up some, it goes up more. When it comes down more relative to where it started, but it never ends up below, it doesn't seem, where the S&P 500 is. So I would say the NASDAQ 100 ETF would be a really nice one. Here's a comparison to the S&P 500 equal weight ETF, the ISPE. That's the iShares version. Equal weight's only up 3%. Now, Gren, this is a pretty new ETF. It's only about a year old, but it's only up 3% over the past year. Not that great. And while we're at it, let's go ahead and compare it to the Russell 2000 ETF. And that one is up 53%, but again, that falls short of the 95% of the S&P 500. Of these, I think I would favor the NASDAQ 100. This would be the one that I would go with. Now let's go ahead and compare some more. So when we're comparing, let's go ahead and compare, in addition to the S&P 500, because the NASDAQ 100 is the clear winner in this here, let's go ahead and use the S&P 500 and the NASDAQ 100 over the past 5 years as our point of comparison. Now on that PowerPoint presentation, we were also going to look at the Magnificent Seven, or the MAGS, which is the Round Hill Magnificent Seven ETF. You can see that this one pretty closely tracks the S&P 500, and you'd expect that since so much of the weight of the S&P 500 is the Magnificent Seven, or has been the Magnificent Seven over the past year or so. This is a newer ETF that it's going to track the S&P 500 pretty closely. Of these three, I do prefer the NASDAQ 100. Let's go ahead and add the XLI, the industrial ETFs. Let's see how that is compared to the NASDAQ 100 over the past, say, 5 years. And you can see, though it's outperformed, no, it's actually underperformed the S&P 500. So we're still going to go with the NASDAQ 100 in this one. What about that cyber ETF that, maybe that thing is really outperformed? That one's up 64, so that one's even worse than the S&P 500. So now let's go ahead and compare the VanEck Semiconductor ETF, the SMH, to the S&P 500 and the NASDAQ 100. And what you're going to find is that the SMH compares very favorably. It's up 318%. The S&P is up 95%. We'll remember that the NASDAQ 100, which had been the winner at 175%, trails the SMH, by a lot. We'll look at the Home Builder ETF, which I expect to have a good year next year. Home building is kind of cyclical, but when you look at this ETF, we're going to find that it's up 246% over the past 5 years, and it's not quite as cyclical as you might think. It tends to outperform not only the S&P, but also the NASDAQ 100. So you might think to yourself, well, the VanEck S&P, or the VanEck SMH ETF is up an awful lot this year. It's actually up about, say, 71% year to date, 63% over the past year. What are the chances that something that's up 71% goes up again next year? Well, let's see how the VanEck SMH ETF actually performs year after year. You can see that it was up 64% in 2019, and followed by a year where it was up 55, by a year that was 44, down 33. This year it's up 70. It was down 9, but just because it's up 35% one year doesn't mean it won't go up 38% the next year. As a matter of fact, this thing is rarely down, and just because it's had a huge year, it doesn't mean that the year after that is also not going to be a good year. So the fact that it's up 70% this year doesn't necessarily, to me, mean that it's actually going to be down next year. Meaning that if you're waiting for a great time to get into this ETF and you're doing it based on, oh, I want to wait till it goes way down before I go up, yeah, you can do that. But just because, like, timing this ETF is not the great idea. That's the way I see it. There's really almost no bad time to get into it. And then that same thing applies to the ITB. Not to the same extent of the SMH, but it's very similar, where it's up 67% year to date, 61% over the past year. But you can see also it can outperform. It can go 48% one year, then 26, and then 40, and then down 26, and this year it's up 60. It follows a very similar pattern to the SMH. The reason why I'm thinking is that, and I think I know what you guys know what I'm thinking, what I'm going to do with my treasury bond money.
You thinking what I'm thinking, partner? Aim for the bushes.
Yeah, I'm going to go into both of these things, and then I might add some NASDAQ 100 with some of the money that I'm getting from, like, some of the other treasuries when they mature. But just to diversify out a little bit more, I want to get in the semiconductors, I want to get in the home builders, and maybe a little bit of NASDAQ 100. All right, first of all, shout out to Bob and Dave. Thanks a lot, you guys, for coming back to this channel. I certainly appreciate it. If you got anything out of this video, yeah, please like, subscribe, notification bell, and thanks a lot, and we'll see you next time. Have a great day. So I'm sad to announce we're going to retire the old mascot for this channel, which is Kate Rooney. But I'm happy to announce she'll be replaced by the new mascot, which is Jumana Bersecci. Jumana actually works CNBC London, and every morning she comes on the television. Let's go ahead and have a look at Jumana Bersecci.
So all of these issues continue to grip markets, and here's the breakdown in sectors. We've got autos right at the bottom again. It is another instance where overnight Chinese equities trade weak, and autos clearly a very sensitive sector right at the bottom today for Europe. Telcos also starting off the day on the back foot.
If you know a word she said, I'll give you $50. All right, with that being said, guys, have you ever had to retire your old mascot only to move in your new mascot? Man, I have, but not until I've had 2 pints of my sponsor this week, which is beer. I really like that. I think I'm going to buy more semiconductor ETFs. All right, so the beer this week is Santa's IPA. Cheers to Rob and Claire for getting me this for Christmas. You guys know what I like. I'm easy to shop for. All right, I definitely appreciate it, and I have to give this beer 5 Jumana Berseccis out of 5. See you next time, everybody.